you a technologist? Or, perhaps put differently, are you a director, VP, or engineer at a technology-based company? If so, RSUs, or restricted stock units, are almost assuredly part of your compensation package. The problem? If you don't really understand what they are and how they work, you're likely losing money and overpaying Uncle Sam. Now, because you are a technologist, this video was designed for you. So don't leave money on the table by not fully understanding your RSU package, and don't overpay Uncle Sam either. Here at TowerPoint Wealth, we want you to make the most of your RSUs, and in this video, we will specifically answer the following questions. What exactly is an RSU? How are RSUs taxed? How do RSUs differ from stock options? How do you effectively plan for the vesting of your RSUs? How do you properly unwind the RSUs you already own? And importantly, how can you reduce the risk of being too concentrated and owning too many RSUs? And of course, how do you minimize the tax consequences of each of these considerations? Now, oftentimes, a significant component of a technologist's compensation package, RSUs can add up and they can potentially become a substantial part of your net worth. Now, before we get started, make sure to subscribe to TowerPoint Wealth's YouTube channel for additional high-level financial content. Just click the red subscribe button below. Hi, my name is Joseph Eshelman, and I am the president of TowerPoint Wealth, a boutique wealth management firm headquartered in downtown Sacramento. And it's time to put your seatbelt on, because in this video, we are going to get into and get after all things RSU related. The result? You will be better educated and better equipped to handle and make intelligent decisions about your current and future restricted stock units. RSUs, also commonly known as restricted stock units, are a form of stock-based compensation whereby an employee receives the right to own shares of stock in the company that they work for, subject to certain restrictions. Now, initially, these units do not represent actual ownership and are not an equity interest in the company, and as such, owners hold no dividend or voting rights. However, once the restrictions are lifted, the units convert into actual company stock, and you, the employee, then owns the shares outright. Now, the restricted in RSUs is generally based on a vesting schedule. Most vesting schedules will fall into one of two categories: time or performance-based. Now, a time-based restriction is based on some period of employment. Common time-based vesting schedules are between 3 and 5 years, with the shares vesting on either a systematic pro rata basis or all at once at the end of a specified period of time via a cliff-based schedule. Now, a performance-based restriction is tied to your company achieving a specific performance goal. Common performance-based vesting schedules include the company's stock reaching a particular market value or price, a specific return on equity for the company, or a predetermined company earnings per share. Additionally, there is a hybrid type of restriction that kind of toes the line between time-based and performance-based vesting, known as time-accelerated. With a time-accelerated restriction on your RSUs, vesting occurs on a time-based schedule, but may be accelerated by the company achieving a specific performance-based goal. When most people think of stock-based compensation, vested stock options, or the right to buy a company's stock at some future date, but at a price established today, called the strike price, are typically what they think of. Now, historically, vested stock options were the most popular form of stock-based compensation. Until 2004, this was primarily due to the stock options garnering favorable corporate accounting treatment, as options issued by a company avoided recognition by the IRS as a compensation expense. However, in 2004, this accounting loophole was eliminated, and subsequently, RSUs, or restricted stock units, emerged as the preferred form of equity compensation. RSUs and stock options do have some notable differences. RSUs are less risky because they carry value regardless of the underlying stock price performance. Stock options are riskier because they can expire worthless. 2. RSUs become actual shares upon vesting. Stock options completely expire, usually after 10 years after the grant date. 3. RSUs have less favorable tax treatment than stock options, something we'll discuss a little bit later in this video. Now, it is important to note that there are many other forms of non-traditional compensation, such as stock appreciation rights, phantom stock, and profit interest, but none of these are as widely used as RSUs or stock options and will not be discussed in this video. RSUs are initially taxed upon the delivery of the shares, or put differently, they are taxed when the restriction has been lifted and the stock actually vests. At the time of vesting, the shares are then included in an employee's taxable income as compensation and taxed at the fair market value of the total amount of shares that vested. The taxation of restricted stock units is identical to normal wage income, and as such is included on an employee's W-2. Now, the shares of vested company stock are subject to federal, state, and local income taxes, as well as Social Security and Medicare taxes. Now, in order to pay the taxes that are due upon your RSU's vesting, issuing companies usually provide an employee with several different options. 1. Net settlement. This is when a company simply holds back a specific amount of company stock to cover the taxes, and the company then pays the tax from its own cash reserve. This is the most common practice. 2. The employee pays cash. This is when an employee receives all of his or her vested shares and covers the concurrent tax burden out of their own pocket. This is a little bit of a riskier strategy than net settlement, as it results in both a more concentrated equity allocation in company stock and also a lower cash balance with which to ultimately pay the taxes that you owe. Number 3, sell to cover. This is when an employee on their own, not the company, sells a specific amount of stock that generates the cash needed to cover the income tax burden of the RSUs. This method provides no real advantage over net settlement and places the additional burden of actually selling the shares on the employee. Now, it's important to note that when an employee ultimately sells their RSUs that are vested, they will pay capital gains tax on any appreciation that occurs over the market price of the shares on the vesting date. If the shares are held longer than 1 year after vesting before being sold, the sales proceeds will be taxed at the more favorable long-term capital gains tax rate. Taxes are always a big concern for those who are receiving RSUs, and even though there is no tax due at the time of the grant, since the shares aren't technically yours yet, the IRS does get its share in time. Taxes will be due both upon your RSU's vesting and upon the sale of the shares. So here's a simple example of how the taxation of restricted stock units works. Let's say you're an employee at Apple and you are granted 3,000 RSUs as a bonus on February 1st of 2022. Now let's say the market price of Apple stock at the time of your grant is $200 a share, and your new RSUs vest pro rata over 3 years. February 1st, 2023. Let's say Apple's stock price is now $220 a share, times the 1,000 shares that you own equals $220,000 of ordinary income. It's now February 1st of 2024. Apple's stock price is $240 a share, times 1,000 shares that vest equals $240,000 of ordinary income to you. February 1st, 2025. Apple's stock price is now $260 a share, times 1,000 shares that you own equals $260,000 of ordinary income in 2025. Each pro rata 1,000 share block will only become taxable as ordinary income on its vesting date. Now, in the example we just looked at, the total ordinary income over the 3 years is $720,000. Got it so far? Good. But wait, you are not out of the woods just yet, as you may have another good tax problem on your hands if your Apple stock appreciates and you then decide you would like to sell some of it. In that case, you would also be subject to capital gains taxes. So continuing with our example, I'll assume that it is February 1st of 2024 and you need some cash for a down payment on a new home. Remember, Apple stock is now trading at $240 a share, and when you sell that entire first 1,000 share tranche of RSUs, the one that vested back on February 1st of 2023, you now have $240,000. However, it is important to remember that your first tranche of 1,000 Apple RSUs vested when Apple stock was trading at $220 a share. That means your total cost basis on that first 1,000 share tranche is $220,000. You waited a year, then sold those 1,000 shares for $240,000. And you will owe long-term capital gains on that $20,000 of additional appreciation, which should be reported on your Schedule D of your tax return. While there is no avoiding paying ordinary income taxes when your RSUs vest, and also really no avoiding paying capital gains taxes upon selling appreciated RSUs, there are strategies to mitigate the tax burden. Targeted charitable giving, utilizing capital losses to offset capital gains, and just outright gifting of vested shares of company stock are 3 ways to reduce your tax burden, each with their advantages and disadvantages. Message us at TowerPoint in the comments section, and let's have a conversation about these. Are you interested in charitable giving strategies or gifting your RSUs? Let us know. Now, receiving restricted stock units can be a wonderful complement to a traditional compensation package and can contribute substantially to the growth of your net worth. However, being the beneficiary of RSUs can oftentimes be a double-edged sword, as there are many considerations and risks involved in properly managing them. The primary risk is that you have too much of your net worth concentrated in one individual stock and concurrently one individual company, your employer. Now, many technologists work in the industry because they are inherent risk takers. And while we firmly believe at TowerPoint that risk taking is an excellent and important personality trait to have, and it typically directly correlates to longer term net worth growth and prosperity, it should also not be done blindly. Often enough, it is difficult for a technologist to be objective about owning, holding, and ultimately selling RSUs issued by the very company that they are employed by. Now, most of the technologists we have met or directly work with as clients are bullish or positive about the future of the company they work for, as they should be. Now, concurrently, technologists tend to be quite optimistic about the future of their company's stock. However, what is completely out of their control and yours is what the financial markets believe about your RSUs, as the market may or may not hold the same level of optimism about your underlying restricted stock as you do. Now, this is not meant to detract from your optimism, but simply to serve as a reminder to be both pragmatic and objective about your RSUs. Let's explore one more scenario. Jim owns 2,000 RSUs with his employer, Snap. On January 1st of 2019, 100% of Jim's 2,000 RSUs vest at $50 per share. Great news, right? Jim's net worth on paper has now increased by $100,000 overnight. Jim decides to hold all of his shares in Snap with the belief the stock price will continue to go up. He also sees his colleagues choosing to hold most of their shares, and Jim fears that if Snap price soars, he will suffer from FOMO and his colleagues will all become wealthier than him. A typical emotional response. However, on July 1st of 2019, let's assume that Snap releases a weak earnings report and the share price drops from $50 a share to $20. The value of Jim's Snap shares is now just $40,000. Even worse, Jim owes taxes at his ordinary income tax rate on the original vested share value of $100,000, even though the shares are now only worth $40,000. And finally, because Jim has a significant portion of his net worth still tied up in the company he works for, he faces an additional and potentially catastrophic risk. What if Snap runs into serious financial struggles and Jim loses his job? Not only will Jim's net worth plunge from further declines in Snap's share price, he also will now have lost his primary source of income. Now, you might see Jim as foolish, but his predicament is a common one. At TowerPoint Wealth, we often see employees dealing with the hesitation to sell their RSUs for reasons that can be more emotional than rational. Now, let's not forget, receiving RSUs from your company is a good thing. However, determining whether you are better off by immediately selling a sizable portion of the vested RSUs and using the proceeds to add to or build a diversified investment portfolio is also an important yet nuanced decision. Regardless, before you do anything, it can be helpful to examine the following important questions. How much of your overall wealth is tied up in your company's RSUs? Is your company growing quickly or slowly? What is your current income tax situation? Is it better to wait more than 1 year after the shares vest to sell them, affording you the more favorable long-term capital gains tax treatment? How long do you plan to be with your company? What is your true tolerance for risk and your relative resilience when declines in the value of your investments do occur? And perhaps the best question to ask, if you've received a cash bonus from your company that was the same size as the value of your vested RSUs, how much of it would you invest in your company's stock? Now, we have discussed today a number of issues surrounding restricted stock units that are out of your control, and some planning opportunities that are directly within it. Here at TowerPoint Wealth, we continue to believe in the importance of a diversified portfolio We also understand that every individual situation is unique and that a growing net worth does mean different things to different people. Emotions can also play a significant and oftentimes problematic role in making sound financial decisions, which is especially the case with RSUs. So if you would like to speak further about your RSUs or any non-traditional compensation you are currently receiving, we're welcome the opportunity to get to know you and to learn more about your circumstances. At TowerPoint Wealth, and unlike advisors at any of the major Wall Street firms, we are a fiduciary to you, and we have a legal obligation to act in your best interests 100% of the time. So let's talk. Feel free to message us here on YouTube or call us at 916-405-9140 or email us at info@towerpointwealth.com to discuss your circumstances further. Thank you for watching this video.